Hello students, my name is Dr. Priya Mahajan and I am from Department of Commerce, Uttarakhand Open University, Haldwani. So by continuing our previous session, now we will study the another components. So the next component is risk management is business investments. Risk management is a key part of business investments. New businesses need to understand and control possible risk and create plans for reducing them to ensure stable growth. Next, we will study some risk management techniques which help the business to minimize their risk. So the first one is diversify investments. So by diversify their finances in different areas, businesses can minimize the impact of failures. Then conduct detailed research. Before making an investment in any project, make sure to study the market, possible profit and risk thoroughly. Then third one is get professional opinion. Consult with finance expert as they can give suggestions and opinions about handling investment risk. Knowing the different types of investment available and applying risk management measures help startups and businesses get the funding they require while keeping possible risk to a minimum. This kind of balance is important for maintaining lasting growth and achieving success in the long run. Next component is the financial reporting and analysis. Financial reporting and analysis is important for newly established ventures to track performance, assess financial health, and guide decision making. So first we will talk about the financial reporting. Financial reporting means preparing and presenting financial statements to stakeholders including founders, investors, creditors, employees, regulators. Key financial reports for a new venture include: first is income statement or profit and loss statement. So its purpose is to show the venture's profitability over a specific period. Key components of income statements are the revenue, expenses and net profit or loss. So revenue means total income generated from business activities. Expenses means the cost incurred including operating, administrative and financing cost. Net profit or loss is the difference between the revenue and expenses. So when revenues are more than expenses, then there will be profit. On the other hand, when expenses of the business are more than the income or revenue, then there will be loss to the business. Second is the balance sheet. Purpose of preparing balance sheet is to provide a snapshot of venture's financial position at a specific point in time. Its key components are assets, liabilities and equities. Assets are the resources owned to the business. For example, cash, inventory, equipment. Liability means obligations or to others. For example, loans, accounts payables. And equity stands for owner's investments and retained earnings. Another financial report is cash flow statement. The purpose of making cash flow statement is to track cash inflows and outflows, highlighting liquidity and cash management. Cash flow statement is classified into three main categories. These are operating activities, investing activities and financing activities. Operating activities include cash flow from core business operations. These are basically the principal revenue producing activities of the enterprises. Investing activities are cash flow from purchases or sale of assets. And financing activities consist cash flow from funding activities such as loan or equity investment. Then there are statement of changes in equity. So purpose of this statement is to explain changes in the owner's equity during a reporting period. So its key components are contribution from owners and retained earning adjustment, that is profit reinvested or dividends paid. Then there comes financial analysis. Financial analysis interpret the data from financial reports to evaluate the venture's performance and financial health. Key methods include ratio analysis, trend analysis, break-even analysis, variance analysis, and cash flow analysis. So we will discuss the first method, that is the ratio analysis. So in ratio analysis, we calculate liquidity ratio, profitability ratio, efficiency ratio, and solvency ratios of the business. Liquidity ratios measure the venture's ability to meet short-term obligation, for example, current ratio and quick ratio. Then comes the profitability ratios. Profitability ratios, they assess how effectively the business generate profit. For example, net profit margin, return on equity. Then there are efficiency ratio. They evaluate how well resources are utilized. For example, inventory turnover, assets turnover, etc. Then solvency ratios, they determine long-term financial stability, that is debt to equity ratios. Then there are trend analyses. So compare financial performance over time to identify patterns, growth, or areas needing improvement. It is useful for evaluating revenue growth, cost control, and profitability trends. Break-even analysis determine the sales volume required to cover all costs, helping set realistic sales goals and pricing strategies. Then variance analysis. Variance analysis compare actual results with budgeted figure to identify discrepancies and their causes. They help refine budgeting and forecasting process. Then there comes the cash flow analysis. So cash flow analysis focus on venture's liquidity and its ability to meet financial obligations. They highlight areas where cash flow can be improved, such as faster receivables collection or better expense control. So these were the various methods of financial analysis. So students, we had studied the 6 components of financial management, that is budgeting, cash flow management, investment funding for business, and cost management in previous session. And in this session we covered 2 more components, and that were risk management and financial reporting and analysis. So these were the important components of financial management for effective handling of the financial resources of the newly established enterprise. Now next we study the challenges for the new enterprise and how they can handle it efficiently. So financial management for startups comes with challenges. Being prepared to handle these challenges is important for keeping the business running and achieving long-term success. So the first one is overcoming funding obstacles. For startups and small businesses, it is crucial to comprehend the various funding options. First, it must be clear about the difference between debt and equity funding. So debt funding implies taking loans that need to be paid back with interest. This is more appropriate for business with strong cash flow, whereas equity funding offers capital without immediate repayment but requires giving up some control. So in equity funding, companies issue their shares to raise the equity capital. The companies can enhance their business credit through timely repayment and can maintain low credit utilization to secure better loans. Other sources of funding, such as crowdfunding, government grants, and industry-specific competitions, might also be beneficial. Second is adapting market changes. The world of business keeps changing, so startups need to change along with it. Always be aware of what is happening in your industry, how the market looks, and what actions your competitors are taking. This understanding can assist you in making careful choice and forcing changes. Be ready to change your business models or plans if the market changes. This flexibility can assist businesses in taking advantage of opportunities and reducing risk. Look over your business processes and financial tactics often to find places where you can improve. Then expert insights and success stories. So by learning from both the successes and failures of others, entrepreneurs can avoid common pitfalls and build more resilient, successful business. Interviews with successful entrepreneurs. Learning from their insights and stories can help startups and small businesses adopt best practices for financial management for their startups, avoid common pitfalls, and set themselves on a path to success. Start simple and stay organized. Rachel Camp, a certified financial planner, established her business in 2022 after facing the challenges of running a startup. She talks about how she dealt with problems that come from running a startup and emphasizes the need to organize and keep personal and business accounts separate to reduce legal risk and liability during tax season. Can focus on educating clients and establishing a strong financial foundation before making major decisions. Her success underscores the significance of starting with a simple approach and incorporating essential expenses into the business plan to alleviate stress and prepare for tax seasons. Then leverage support system and outsource wisely. Catherine Knighton shared insights from her experience at Collective, a platform designed to help solo entrepreneurs and micro business owners. She noted that many businesses owners come to Collective for guidance on the right way to start and manage their finances. Knighton stressed the significance of informing entrepreneurs about their choices and the necessity of commencing with a well-defined and systematic strategy. Her success story highlights the advantages of distinguishing personal and business finances and seeking advice from financial experts to prevent expensive errors. Then learning from business failures. Kemp and Knighton pointed out a common problem among startups, especially solo entrepreneurs trying to handle all business finances on their own. That many business owners make errors and increase their liability by doing their own bookkeeping and accounting to save money. The important lesson is knowing when to outsource financial management to professionals. Camp experience with clients struggling due to inadequate financial planning serves as a warning. She noted that many solo entrepreneurs don't set aside enough funds for taxes and other financial responsibilities, leading to stress and potential legal problems. Also, lacking a support system and failing to seek advice from other entrepreneurs can often lead to business failures. Knighton stressed how crucial it is to join a community of fellow entrepreneurs and small business holders to share knowledge and gain confidence. So to conclude, we can say that startups and business need proper financial management for success. Knowing how to create a budget, handle cash flow, and make smart investment will help entrepreneurs establish a good financial footing. Keep in mind that a strong financial plan needs continuous review and modification. Gain inspiration from successful entrepreneurs and apply their wisdom to guide your own journey. By utilizing effective financial management practices for startups and seeking advice from experts, you can lead your business toward a prosperous future. So this is all about this session. I hope you will like these sessions on financial management. So thank you and happy learning.